Today, we are going to be discussing how you can build a dividend portfolio that will outperform the 10-year Treasury yield. It will outperform CDs. It will outperform a high yield savings account. And if this intrigues you, we're going to build a dividend portfolio right within our Wealth Grid tool and show you exactly what your dividend payments are going to be over a month, quarter, and over a year. But also, more importantly, we're going to show you how to supercharge your capital that you're going to be deploying in these dividend stocks by actually writing covered calls against them. So with that, let's jump in. Okay, I promised you a dividend portfolio that was going to outperform the 10-year Treasury yield at about 4.7% per year, right? Outperform any CDs that you could possibly get in the market and outperform, quite honestly, the S&P 500. So is this even possible, Ricardo? So let's first get a baseline of exactly, what you can get if you deployed X amount of money today, right? So first and foremostly, if you deployed that capital in a 10-year Treasury bond, right, which you don't have to hold for 10 years, but you will get penalized if you actually pull that money. You are looking at today's rate of a yield of roughly about 4.5%. It was as high as 4.7% a couple of days ago. All right, so that's for your US Treasury. But what return on your investment could you expect if you actually put that money into a certificate of deposit, right? So here's some of the latest CDs available for 2006. And if we deployed roughly about 350,000, you can see that the CDs available for you is going to pay you roughly about a 4% yield, right? So 4%, 4%, 4.15%. So I'm doing this because I want to show you what the baseline is. If you deployed capital, let's just assume it's 350,000 across not only a Treasury bond, right, a 10-year Treasury bond, or putting that into a CD, a certificate of deposit, or even maybe a high yield savings account. Your high yield savings account is probably going to be about the 3.84% range, right, that you're going to get from a return for the year. Now, the goal for this video is to actually show you that we can actually get a lot more than 4% a year for that 350,000 that you're actually deploying. And I want to show you exactly how we do this. So the application that you're looking at the moment is called the Wealth Grid. And we built the Wealth Grid because we wanted something a little bit more robust to actually track our own portfolio. And what we've built into this Wealth Grid is the ability to actually track your entire portfolio, your holdings. We also do trading on a day-to-day basis. But we also have a dividend portfolio, right? And we wanted to actually see exactly how much dividends we could expect at the end of the month, at the end of the quarter, at the end of the year for a specific equity that we had invested in. We also built this portfolio builder. Now, the dividend portfolio builder is a simulation tool, and we've actually built this for newer investors just to give them an idea of what they can expect if they invested in specific equities, right? And today I've taken a portion of our portfolio and I've actually stuck it into this dividend portfolio to give you an idea of what you could possibly expect from a return perspective if you invested roughly about 350,000 into these dividend stocks, right? So first and foremostly, what are we looking at here? We're looking at a dividend portfolio of roughly about 342,000, right? Our annual dividends that we're going to be getting off these investments that we've made is going to be 6,800, 6,900, right? Our monthly income, $570, and our portfolio yield is 2.01. Now, if you look at that portfolio yield, you're going to say, but Ricardo, we can actually get more money if we stuck our money into a 10-year Treasury, right? Or we could get more money if we put it into a certificate of deposit, or we could even get a better yield if we stuck it into a high yield savings account. And you are absolutely right. But here's where most investors miss the opportunity to actually make real money and to scale their return on their investment. And that is exactly what we are going to talk about today. And I'll show you how that is done with this $350,000 portfolio. Right, so we know that the yield is 2.01%. I want to go through some of the equities that we've pulled from our own portfolio and put it into the simulation. I've also used the dates that we've actually bought them at, just to simulate what dollar cost averaging would actually mean for you as an investor, right? So from a sector's perspective, we are pretty balanced here from a sector's perspective. Technology, 22%, consumer cyclical, 27%, communication services, 18%, Bit scarce on healthcare, 16%, and then we've got about 13% within finance. And this portfolio is super light from a energy sector perspective because of all of the volatility that we're experiencing today within the energy sector, right? So what are the companies that actually makes up this dividend portfolio? Well, I worked for eBay, PayPal, and CBS, so there'll be some eBay in here, right? Stocks that we actually had already. There's some Google in there, Amazon, Netflix, growth stocks, right? Then there's JPM, which is in the finance sector. A couple of communications. VZ is a really good stock to have from a dividend perspective. UPS, Microsoft, Oracle, etc. There's some growth names in there as well. And you can see exactly what their dividend payout is for each one of the tickers that we've selected, right? We've bought 350,000 worth of equity in all of these specific companies. So here's the interesting thing that you've been waiting for, right? When we built this wealth grid, we wanted to be able to track our payments from a dividend perspective on a monthly basis, on a quarterly basis, and on a yearly basis. So we knew exactly how much money was actually coming in the door, right? Not guessing, not just, hoping that somebody's going to actually pay us a dividend at the end of the day, or that there's going to be some money in the bank account. But we wanted to be able to see this visually, and this is exactly why we built this dashboard. This dashboard is specifically for dividend investors, as well as for option traders and day traders. You can put your entire portfolio in here. There's a trading journal. There is so much tools that will help you assess a specific ticker, and we'll go through some of that a little bit later. But here is the dividend companies that we had invested in, and you can see the monthly return that they are giving us. For example, Amazon, we've got 100 shares of Amazon. There's no monthly payment, right? Because there's no dividend that Amazon actually pays. eBay, we've got a ton of stock left still from legacy corporate shares that was actually given to us. Google, Alphabet, HD, and you can see the list goes on and on and on. It's broken down by monthly, quarterly, as well as annual dividend payment. But here's the kicker. We've also incorporated something that's called a covered call strategy. And this is the second leg of the wealth triangle. And if you want to know a little bit more about our wealth triangle strategy, then come and join us at the Wealth Circle. There is a ton of information around this specific topic. And if you're new to the term covered call, don't worry, it's super simple, right? No jargon here. Think about it as you renting out your stock. Just like if you had a vacation home somewhere, you'd rent that vacation home, right, on Airbnb. This is exactly the same thing. You're renting your stocks to somebody that pays you a premium every single week. In this case, we've actually aggregated the covered calls that you can actually sell on a monthly basis, right? So this is your monthly income for covered calls that you're actually selling. If you did these covered calls on a weekly basis or on a bi-weekly basis, there'll be a little bit more management with regards to the position, and your returns will be a lot more than the returns you'll get on a monthly basis. So what does the returns actually look like, Ricardo? The companies that you're investing in is going to pay you a dividend over the year of roughly about $6,877. Then you're going to overlay a covered call strategy, which is our second leg of the wealth triangle strategy on top of that. And that's going to give you an extra $4,134 per month, not per year, right? So let's just do the calculations at the back of an envelope here. So we are getting roughly about $4,134 per month in selling covered calls. We're going to multiply that by 12 because we're definitely going to be doing this every single month, right? Which will give us a grand total of roughly about 49,000, let's say 50,000 break even for the year. On top of that 50,000, we are going to add the dividends that the company is paying us for that year, which is going to be plus $6,877, right? So essentially, you are making $56,000 on your $350,000 investment that you made in these dividend paying companies. Now, is that going to be more than your 4.7% in a 10-year Treasury account? Is it going to be more than you can get in a HYSA? Is it going to be more than you can get in a certificate of deposit? Let's see, because all of this money is absolutely liquid, right? If we divide this total by the $350,000 that you actually invested, your return multiplied by 100, obviously, yeah, your return is going to be 16%. That is literally beating out the S&P 500 in most years, right? Average return on the S&P 500 is anything between 8 and 10, 11%. You are making more money off running your own dividend portfolio than you can actually get by just sticking your money in the S&P 500, right? And this, people, is exactly how the 1% makes their money work for them. So if you're interested in knowing exactly how to make your money work for you and what the mechanics are behind actually creating, a return on your investment with a dividend portfolio like this, then come and visit us here at Mindshift Theory. We have a ton of educational content that will show you exactly how you can execute the strategy. And if you are interested, we also have a cohort program running on a monthly basis. And if you decided to join one of our cohorts, we will show you exactly how to execute on this specific strategy. We will also give you all the tools that we have to actually help you. Tools like the wealth grid that you're seeing in front of you at the moment, as well as PACE. So the bottom line for this video is as follows. We all have choices, right? You can either take your money, whether that be 100,000, 200,000, 300,000, 500,000, and you can stick it into a 10-year Treasury bond. You can stick it into a HYSA, you can stick it into a CD, or you can come and join us here at the Wealth Circle, and we can show you how to make that money grow like the top 1% makes their money work for them. You can either get a 4 to 5% yield, or you could get a 16% plus return on your investment implementing the wealth triangle strategy that we teach. So we hope that you will join us here at the Wealth Circle at Mindshift Theory. And with that, I will see you in our next video.